and certainly what's going on in some sectors. I mean, healthcare has been one that's been down for several years now, but the art market just seems to keep going, no matter what's happening. So what is the state of the art market, and do you think this kind of price acceleration can possibly continue?
Well, the market seems to be doing quite well. Through last year, through the end of 2007, our All Art Index was up 20%, while the S&P total return was up 5%. And everybody at that time was beginning to worry that maybe we're at the top and it's a bubble.
Good case for diversification, incidentally.
Exactly.
At any rate.
And now we've had the auctions this spring, and they have certainly not been bad. They've actually been quite good. I was just looking at some of the returns of individual objects, and in the post-war and contemporary, when we look at all the returns of the objects that sold at auction with a prior auction sale, returns were way over 20% on average. Impressionists were up over 10%. And even American paintings, which you would think might be the most affected, that is American paintings created before 1950, also did quite well. The returns were slightly less than 10%, but still positive. So art tends to be, what history has shown us, is that it really takes a prolonged and substantial downturn in really global wealth before you get the art market turning down. And historically, it's been 6 to 18 months before it turns down. And it might be that the downturn, while severe here, hasn't been sufficient throughout the world to really change the market.
Interesting. All right, so Bruce, one thing that hasn't changed at Fairholme is, and you mentioned it, that you pay a lot of attention to cash, to free cash flow in companies. So why is free cash flow so important?
Well, cash is the only thing you can spend. So thinking about, that's it. That's all you can spend. You can't spend clicks. You can't spend eyeballs or visits or market share. Or it's what we need, cash. So it's just like the corner grocery store. We think of companies with one cash register. We watch what comes in. We see what comes out. After paying all the bills, the labor, inventory, taxes, interest, what's left is the free cash for the owner. And then we look at capital allocation. What do you do with the free cash?
Right.
Do you give it to your owners? Do you reinvest it in the business to make it grow? Do you invest it in another area? So you could have good free cash, but you have to make sure, I guess in the words of Peter Lynch, that the owner-managers do not diversify and or use the money to buy back stock at a ridiculously high price. So there's the free cash, and then of course there is the capital allocation process and how good the owner of that store or that company is in reallocating the cash. And
so let me ask you about that to a point which Berkshire Hathaway is your largest holding, the Fairholme Fund. And Warren Buffett is sitting on, what, $40 billion of cash
yes.
still? So, I mean, is that a good, use of the cash? I mean, when you're there as a shareholder, I mean, couldn't he share a little bit more of that cash with shareholders?
Well, you could argue that he could afford to maybe throw all of his shareholders maybe $10,000 a share. But
right.
There's an element of his reinsurance businesses that require, and Geico auto insurance, there is an element where you always have to have an amount of cash on hand. And he is one of the greatest promoters the world has ever seen, and there will be a time when, whether it's a Wrigley's and maybe Mars one day, where there will be a $30, $40, $50 billion acquisition. He obviously believes it's still possible, because I do believe that if he did not think so, then we would see the cash coming back to owners. He fully understands the principle.
All right, so you're not frustrated by him having that cash position?
No, I am not frustrated, but you have to, I mean, Berkshire, you have to listen to Mr. Buffett.
Right.
The company is going to maybe do a few percentage points more than the S&P 500, and that's it. It's a big company, and one day there'll be a new captain at the helm, and so you have to listen to what he says. It's still going to be a good investment,
yeah.
But it will not be the investment of past decades.
All right, that's quite a statement. So Marty, at Fridson Investment Advisors, you look for discrepancies in relative value in the high yield sector. So where are the biggest discrepancies now?
Recently, the loan sector has been pushed down. Those are not quite securities. It's not something that individuals can readily go
right.
out and buy. but it's certainly an area that people in the credit market look at the loans on a secured basis. And what's happened since the credit crisis began, there's been greater technical pressures on the loan side than on the bond side. Everything's been hit. Everything had liquidity problems. But on the loan side, you had some special circumstances related to unwinding of total return swaps, the disappearance of the collateralized loan obligations, which were really the biggest buyer right up until the music stopped. So because of that, in addition, just the lower absolute yields as the short-term rates came down, there was greater selling pressure there than on the bond. So you got some very, very good relative values. That's started to move back, as inevitably it will, as that value is recognized. But there have been some very good opportunities there.
So that's for institutions, as you said. What about for individuals? Are there any big discrepancies in the bond market overall, maybe not just in the high yield market, that you're seeing?
Well, right now within high yield, the automotives have been pushed down very severely. Not surprising given what's going on, but we found that you have to be a bit of a contrarian if you're looking for relative value plays. It is genuinely the things that are out of favor, and you get paid well for owning that. And there are industries that do well. They're great businesses. They're very safe, and the market unfortunately recognizes that. We tend not to see industries that are clearly doing very well that are selling dirt cheap. May happen somewhere else, but not in the high yield market.
Right. It actually probably doesn't happen in many other markets as well. So, Michael Moses, are there any valuation discrepancies developing in the art market that you're seeing?